Welcome to Research Recap, our research series here on JP Morgan's Making Sense podcast channel. My name is Sam Azzarello, and I lead content strategy for global research here at JP Morgan. Today, I'm joined by Michael Feroli, our chief U.S. economist, to discuss the November jobs report. Mike, thanks so much for joining us again on the podcast. Let's start with the high-level numbers. Talk us through changes in the unemployment rate and jobs added for the month.
Yeah, so we got 199,000 jobs added this month, which was a little better than expectations. There were downward revisions to prior months, and it was supported by about 40,000 returning strikers, auto workers, and Hollywood writers. But nonetheless, it was a good number. We also, as you mentioned, saw the unemployment rate move down more than expected from 3.9% to 3.7%. Over the past 4 months, it had moved up from 3.5 to 3.9. So that takes away some of the concern that it was moving in a recessionary direction. And then most of the other details of the report were similar to the headline, which was a little better than expected, albeit with some modest downward revision to prior months.
So let's go a little deeper on that idea. There's a lot of focus on the numbers in the report in the month that we see. How do you compare that with revisions to previous months on balance? What would you say the state of the labor market is?
The state of the labor market is, as it has been for the past 3 to 6 months, pretty healthy. It's growing at a pretty consistent rate, a little under 200,000 jobs per month. And yet we're seeing, generally speaking, cooling in wage pressures. So one might be concerned that this still resilience in the labor market is creating a problem for inflation, but actually it's occurring against a backdrop in which wage growth has been moderating to more sustainable levels. So overall, it looks like a pretty good combination altogether.
Okay, great. You already mentioned the strikes in passing. The UAW and Hollywood workers coming back, are you thinking that's adding noisiness to this report? And can you provide more details on that piece of the labor market report?
Well, that was expected noisiness. There's always noisiness in these numbers. We know from the strike reports that both of those subtracted, 30 to 40,000 cumulatively over prior months, and they probably added about 40,000 to that headline number we saw today. So we might want to frame it as X strikes, we added about 160,000 jobs this month. Now, there's, of course, other sources of noisiness as well. Retail employment was down pretty significantly, but there may be changing patterns in how, holiday shopping evolves and how that's delivered. So, in any number, you're going to have all sorts of noise, which is why it helps to look at 3-month averages and things of this nature. At least the strikes were expected noise.
Okay, and then last question for you. We have an upcoming Fed meeting. Does anything about the November labor market report imply a change in communication or direction of Fed action?
I don't think so. While it was a strong report, it, as I mentioned, came with, generally pretty favorable data on wage inflation. So I think that combined with what we saw earlier this week, which was a decline in job vacancies, and what we saw after the number this morning, which was a decline in inflation expectations, I think overall the Fed has to look back at this week and say it was a pretty good one for the soft landing narrative, and so I don't think they are going to really rock the boat next week.
Thanks, Mike, for joining us on Research Recap. Looking forward to talking to you again next month, and thank you to our listeners for tuning in. For more research insights, visit jpmorgan.com/research.
Thanks for listening to Research Recap. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. This communication is provided for information purposes only. Please read JP Morgan research reports related to its contents for more information, including important disclosures. Copyright 2023, JP Morgan Chase & Co., all rights reserved.